As we wrap up the last day of the quarter, now we look forward to the second half of the year. Is it going to be better than the first half? That's coming up on 3 Minutes on Markets and Money. The S&P, the NASDAQ, and the Dow have all started out with some of the worst performances ever on record. The Dow is currently posting the 5th worst start to any year. The NASDAQ has the worst start of any year on record for the markets. What does that mean going into the rest of this year? Well, historically speaking, outside of a recession, stocks tend to do better in the last half of the year. But therein lies the question, right? The risk of recession. A lot of the economic data we've been seeing lately certainly doesn't bode well for the economy going over the next few months. The risk of a recession has definitely risen here lately, particularly as the Fed continues to hike rates, reduce monetary liquidity. That's impacting these markets more and more. The risk now is to the downside, unfortunately, if a recession hits. Historically, we see markets go lower. As an example, the NASDAQ, last time it had this tough of a start to a new year was in 2000. Of course, 2001, markets continued to fall even more. So even though the market's already down sharply this year, there is more downside. And particularly, this goes into whether or not there is a recession as it relates to earnings. Outside of a recession, earnings get revised down about 5%. Now, that would currently suggest about a 6% upside to markets from here based on current valuations without a recession. However, inside of a recession, earnings historically get revised down about 20%, which means there's about another 19% to go for markets. See, there's the real risk. Ultimately, this comes down to earnings, valuations, and adjustments. And right now, those earnings have not been revised down enough to compensate for the risk of an economic recession, because as the economy slows, so does revenue coming into companies. Now, yesterday, markets were able to hold on to their support level. Today, we're going to look to open below that level. Question is whether or not we can hold these recent lows or not. Now, if we fail to hold those recent lows, markets are going to go lower here, looking to test around 3,500 if we break those lows. Now, the first 2 weeks of July tend to be a little bit better performance-wise as we start the second half of the year. We begin a new quarter. Potentially mutual funds want to get some assets on the books. So again, if markets going to kind of hold support right here, there is an opportunity for the markets to rally back to these previous kind of highs here that we set just a few days ago. Outside of that, though, the visibility to the markets is very tough right now because of what the Fed is doing, next set of Fed rate hikes, and of course the economic data. So trade carefully and use rallies to reduce risk. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you next time.